Alrighty. Thank you guys for joining us today. And again, today we're going to be covering estate and legacy planning for tech employees, where we'll give you a few key and actionable ideas to help you plan for your future. For those of you joining us for the first time, Alfonso is a flat fee wealth advisory platform, and estate planning is a big piece of that. We have estate planning advisors, attorneys, and insurance advisors to help you build out an efficient end to end estate plan. My name is Mike O'Connor. I'm part of the growth team here at Alfonso, and I've been working in tech and startups for over 5 years now, from bootstrapped small teams to Series C and beyond. I'm a big reader, everything from nonfiction to epic fantasy. So feel free to post some book recommendations in the chat, along with any questions that you might have throughout the presentation. And we'll be doing a Q&A at the end to answer all your questions. Our speaker today is Brian Kirby. He's on the advisory team at Alfonso. He has over 20 years of experience in advisory and estate planning. He began his career as a retail advisor at Merrill Lynch. After a few years, he moved to the institutional side, where he worked on mega corporate plans. He was one of the servicing managers on the Apple plan, as well as government 457 plans, 403B nonprofit plans as well. On top of all that, he has extensive experience in the executive benefit and liability planning focused around complex estate modeling. So with that, I'll go ahead and pass it over to Brian.
Thanks, Mike. Welcome, everybody, and thank you for joining us today. Today's presentation focuses on estate and legacy planning. When most people think of estate planning, they think it only applies to the ultra-high net worth. This is a common misconception. The main purpose of a well-funded estate strategy is to have a plan for the people you most care about and transfer assets efficiently and privately. Privately being one of the most important issues of setting up your estate plan. Generally, how you set up a plan depends on your current situation. Are you in the accumulation phase or the distribution phase? During the accumulation period, the main goal is to protect your heirs. In the distribution period, the main goal is wealth transfer and tax mitigation. For our example today, we will focus on the accumulation phase. We will use a married couple, Bill and Susan from California, both aged 45, with 2 young children. They own a primary residence and approximately $5 million in total assets. Now, one of the most common questions that we hear is, do I really need to have an estate plan? I already have a will. The answer is a resounding yes. A will does not avoid the probate trap. While it can reduce the cost and length of probate, assets are still exposed to it. The reality is that families with young children and meaningful assets often have the greatest need for planning because there are so many moving pieces involved. So our goal for today is to provide a simple framework around a few key objectives. First being protecting your family. Second being preserving wealth. Next, avoiding probate. And then creating a structure during any issues with incapacity or medical situations that you would need someone else to step in. With this, we're going to focus on 3 core areas of every well-designed estate plan. That's going to be creating a trust, creating a pour-over will, and financial planning designed around funding and titling of assets. Okay, so let's start with creating a trust. So this is going to help us in a few ways. As I mentioned earlier, it's going to avoid probate. Okay. Also, it's going to maintain privacy. So assets in a trust are not on the public record and they are not in any court documents. Allows for smoother asset transfer based on specific instructions. Okay. It provides instructions on how the assets will be managed. And we'll go into that a little bit later. Next, we're going to create the last will and testament. So this is going to direct asset distributions, going to name guardians for children, and it's going to coordinate any assets that are in probate. Okay. Then we're going to want to add a durable power of attorney, healthcare proxies, um, and HIPAA documents. Okay, this is crucial for financial authority if there are any issues, as I mentioned earlier, with the capacity. Okay, um, also this is going to allow proxies to make healthcare decisions and guide end of life directives and healthcare preferences for the individual. Okay, so let's go back to the trust, and we'll focus on the type of
Brian,
trust.
I think we might be on the wrong slide.
Is it not going? Uh,
There we go. It's on.
there it is. Sorry, my
Oh, no
mistake.
worries.
The trust we're going to be using for this example is going to be the revocable living trust. Okay, so the trust is really the foundation of all estate plans. Many different types of trusts, but for this example, we're just going to use a revocable living trust. Okay. Instead of assets passing through probate court, the trust governs how assets are managed and distributed. Okay. A trust also allows parents to establish rules around inheritance rather than distributing assets outright at age 18. This creates greater efficiency, privacy, and continuity for the assets that are transferred. Now, one of the most common mistakes that is made by families is failing to create a structured distribution guidelines. One example of this is going to be a structured distribution guideline that breaks it into thirds. So your heirs receive your assets. According to the trust, 1/3 of the assets are distributed upon university graduation. What this does promotes higher education. Okay? Another portion is going to be distributed at age 25. This is going to help promote financial maturity, teach them to budget correctly, teach them to pay their bills on time. The remaining balance is going to be distributed at age 35. Okay, this is going to help preserve long-term financial stability. This type of structure helps ensure the inheritance provides meaningful support over time instead of becoming a short-term windfall. Another benefit of a trust is to provide securities for the assets distributed. A trust could shield assets in cases where the beneficiaries are involved in divorce, bankruptcy, and credit situations. And it could also shield against reduction in government benefits. Now, a couple of those are crucial, especially when your beneficiaries are later on in their life and they may be looking for government services to provide long-term health care. Okay, these assets held in these trusts will not be included in those calculations. I also mentioned divorce, which is something that is quite frequent. So imagine the scenario: you build up all these assets. Okay, you do a good job, you pass everything down to your kids. You don't have a trust. Your kids get married. The marriage goes awry. Okay, their spouse is then entitled to 50% of those assets that you worked so hard to create. So that is one of the main benefits of providing uh, a living trust, that it will shield that down the line when you're not around to help make those decisions. Okay. Next, I want to cover the pour over will. So what a pour over will help do is this document will help capture any assets that may remain outside of the trust, and per, based on the instructions in that will forward all of those assets directly into the trust structure. So for parents of young children with this, you also want to take a close look at your guardianship plan. Okay. This becomes one of the most important decisions in the entire estate plan. A properly designed will should include primary guardians, backup guardians, and something that's almost always left out: temporary emergency guardians. Sorry, I'm having a little issue here on my other machine. Okay, there we go. Okay, so Why do you want temporary emergency guardians? Say there's a situation where something happens and the primary guardians are traveling or they're not available to step in right away. Having temporary emergency guardians provides that stopgap in any situations like that. So it's a very important thing that you do want to add to your will when you're doing your trust plan, when you're doing your estate plan. Okay. So a couple things that you want to look at when you're choosing your guardians. So families should carefully consider parenting philosophy of the guardians, emotional stability, geographic location, age and health, their personal values, and the existing relationship with their children, as well as financial stability. Many families also choose to create what's called a legacy letter. Okay, this helps guide the guardians in raising children according to the family's values, benefits, and long-term vision. Also, incapacity and healthcare planning is something that I didn't make a slide on, but it is something that is very important, and you do want to consider that when you do your estate plan. So you want to make sure that you have incapacity planning documents. Typically, you're going to be your durable financial power of attorney, healthcare proxies, HIPAA authorizations, and advanced healthcare directives. Without these documents, families may need court intervention to simply manage finances or make medical decisions during an emergency. So again, these are something that are going to be very important when you're creating your estate plan. Also, something that is often overlooked is beneficiary designation planning. Just about every asset that you have has some sort of beneficiary designation planning. With bank accounts or brokerage accounts, these could be called TOD, transfer on death. So just like an insurance policy, every asset will have a beneficiary designation that you can utilize, and that goes even for real estate. That becomes a little more complicated with real estate because it's going to differ from state to state and county to county. So generally, it is a transfer of deed with naming a beneficiary. It needs to be notarized, and there usually needs to be a witness. So that could be a little more complicated, but it is something that you have available to everybody has available to them in every asset. Okay, so when you're looking at your assets that you want to retitle, you're going to look at brokerage accounts, real estate, any interest in LLCs, bank accounts, retirement plans, and also insurance policies. Okay.
Um,
Now I mentioned retire. Sorry.
oh, no worries. Right quick, I was
No.
just going to get to a couple questions. One was just when is the ideal time to start thinking about an estate plan, age wise or net worth wise?
When you are planning on having children or starting a family or already have, that is the time you should be looking at it. Because from an asset perspective, you don't have to have a lot of money. You have a house, you are married, you have other concerns and things that you want to look at, whether that's going to be identifying who are going to be the guardians. Those are things that an estate plan is something you want to address immediately when you either begin thinking about having a family or have a family. Or if you don't have a family and you have other assets and you are charitably inclined and you want to create a legacy through charity, another good reason to look at creating an estate plan.
Got it. And the next
Okay.
one was is the screen share still stuck on a previous slide or is it on the correct one now?
No, I'm working up to the trust slide.
Okay, got it. Then we'll save
Yep.
the others for
Oh, you can go ahead
a
and ask
little
it. It's
later.
fine.
Okay. What can cause probate?
Uh, well, assets that are not held properly in a trust. You can also have probate issues if there's testability. So you have assets that maybe have beneficiary designations, but then you have two kids or three kids that are um, arguing about, specific shares. So those are a few things that will create anything outside of the trust is going to go through probate. Now, if the beneficiary designations are set up, it's going to be a very long process and a very expensive process. I think I read in the state of California, an average probate case now is a year and a half. Okay, so it can, and you're looking at upwards of $20,000 in legal fees just to get assets through probate. So that's something that creating a trust is really that's your goal is to stay out of probate as much as possible. Stay out of the courts. Keep everything as private as possible and off of court records. Okay. One thing I wanted to mention about retirement accounts, so RIAs, 401ks, um, due to the Secure Act, most inherited retirement accounts must be distributed within 10 years, which can create some significant future tax consequences for children and beneficiaries because everything that you receive from that is going to be taxable. Okay, so there are some planning opportunities that if you're looking at an estate plan that you would want to look at around retirement account planning. So specifically doing Roth conversions can be um, can be very beneficial. Doing utilizing tax diversification inside of your plans, and then obviously coordinating those around your trust. So when you're looking at retirement accounts, don't leave those separate because there are some pretty cool strategies that we work on that will alleviate some of those issues. Okay. The next thing
Got
I
it.
want to cover uh, is going to be life insurance. Okay. Okay.
There's just one more question, right
Go
quick.
ahead.
What's the need for a pour over will?
A pour over will, the main benefit of a pour over will is any assets that are outside of a trust due to the instructions on the pour over will automatically pour into the trust upon death. So a pour over will helps capture those assets outside of the trust and pulls them inside of the trust. Okay. So, okay. I'm going to leave this screen up because I'm going to go into trusts a little bit more here in a minute. Um, but one thing I wanted to talk about is life insurance planning. Okay, because specifically in many trust situations, life insurance is often the funding primary mechanism. That's going to make your estate plan successful and tax efficient. Okay, so a couple factors that you want to evaluate when you're considering the types of policies. Okay, because you have term and permanent. Right? And I'll get into that in a little bit. But some things you want to consider is the duration of the need, um, policy type, term, and permanent, your outstanding liabilities, and your ownership structure. Okay. So, one commonly overlooked strategy in insurance planning is policy structure. Many times I see clients with improper durations relative to their liabilities. Okay. So, this creates unnecessary costs and is inefficient. What I mean by that, see someone with a 30-year term policy that's covering a liability that ends in 10 years. Okay. It's an unneeded expense and structured properly, you can avoid that. Okay. So I like to look at it, if you take the human capital approach, all right, every year you're working and every year you're funding retirement plans, you're funding education plans, you're paying down mortgage, you're increasing your investment portfolios, and you're reducing the liability. Okay, so every year that you work in the human capital scenario, you are tightening that liability. Okay. So I prefer looking at a ladder structure and compartmentalizing specific liabilities. Right. So if I have a 30-year mortgage, I know that I want to cover that for 30 years. Now, although that mortgage is going to decrease over time, I still look at it and saying it's a 30-year liability. I want to cover that from day one. Okay. If I have education planning needs and retirement planning needs, so I have a kid that's, 7 years old. Okay. So I want to look at covering that education liability for, say, maybe 10 years. Okay. Um, Retirement planning. You're going to fund your retirement plan every year. You're going to max it out. You're going to get your match. Maybe you're going to do some Roth conversions. Okay. But if you're, 40 years old and you want to retire at 60, you only need to cover that liability for 20 years. Okay. So structuring policies in a way that compartmentalize and cover liability specifically in the long run uh, saves you thousands of dollars. Okay, because when you are doing an underwriting for a policy, a large policy to cover everything for 30 years, it's a lot more expensive than covering something for 10 years, 20 years, and then maybe having a longer term liability coverage for 30 years. So you save yourself over the duration thousands of dollars, which, in my opinion, should go to retirement and investment accounts, which pays dividends in the long run. Okay. One other thing, too, in regards to policies is if a policy is personally owned, the death benefit may still be included in the taxable estate. So it's potentially creating estate tax exposure depending on state where you live and your federal estate tax situation. Now, this year, the exemption went up to 15 million per person. Okay. Now, how that works is each individual, so a husband and wife, each have $15 million. Okay. So that's a total of $30 million. So that's on the federal level. Some states have different rules. So that's where, we partner with attorneys because I don't know every rule for every state and every jurisdiction. Because even in a state like California, specific counties can have different rules. Okay. So an estate tax attorney is someone that we bring into our planning just based on having someone local that understands the environment where they are is very important. It's crucial, actually. Okay, so an example of that. So you at the federal level, husband and wife, you have 30 million. So you have the husband has 15, the wife has 15. The husband passes away, his 15 million transfers to the wife. So the wife can get the full $30 million estate tax deduction, as opposed to a state like, let's see, Washington. I was just reading about this. So they have $1 million deduction on each spouse. The issue is it doesn't carry over. So you have 2 million. The husband dies, the wife doesn't get the 1 million. She only gets her 1 million. So there's nuances to that really need to be investigated closely when you are doing, especially more advanced trust planning. And I'll cover a little bit of that, although, you know, um, I will end up talking for 3 hours and it's Friday night. I'm sure you guys all want to get home. Okay. Um, so a couple things that you may want to look at also when you're looking at your life insurance is determining what the needs are. So things you want to look at: income replacement. So if you are 45, you walk out the house tomorrow, get hit by a bus, what income would you have been earning for the next 15 years? Okay, that may be something you want to look to replace. Overall debt, you want to look at, okay, something happens, I want to make sure that my debt structure from my spouse is very, very low. Estate liquidity. So any outstanding issues you might have with your estate, whether that could be, if you have business interests, buy sell agreements, things that you need to have cash to pay off, you want to make sure that's covered. Also, equalization too. You want to make sure everybody gets a fair amount. All right. Now, one thing I do want to cover, and this is kind of something that lately has been um, a lot more relevant. Okay, and that's digital estate. So, digital estate organization is something that is way more relevant today than it was 10 years ago. Okay, so every family should consider creating a digital planning document. This should include things like password manager access, uh, cryptocurrency access instructions, cloud storage inventory, uh, digital asset inventory, and social media instructions. Okay. So as we become more increasingly digital, organizing these assets has become a much more essential part of your estate. Okay. I left this trust screen up because I want to go through a couple different types of trusts here. So essentially, there are two types of trusts. In each type, there's a bunch of subsets of trusts that do different things. Okay. But basically, you're looking at revocable versus irrevocable. A revocable trust, also known as a living trust, allows the grantor to remain in full control of the assets. Okay. Now, in this situation, assets remain part of the estate. Okay. So they remain taxable, right? The benefit of this is you have flexibility. Okay. So they avoid probate. They're private. So any of the assets, like I said, mentioned earlier, don't go through any documents, no public documents or anything like that. Very important. And then again, it's the flexibility. So if you have a revocable living trust, you have the access as the grantor, you can change beneficiaries. You can add or remove assets. You can modify distribution terms. Um, you can revoke the trust completely. Now, how does that apply? So, an example. So, I had a client had a living trust, and one of their kids had substance abuse issues. Okay, so he wanted to restructure and modify the distribution terms for that individual. Having a revocable trust allows you to do that. Okay. Also, um, it provides an ability to have a successor trustee that can step in to manage assets efficiently. If something happens to you where you are incapacitated, you can name that so it gives you the flexibility there. So now, basically, for many families, revocable trusts serve as the operational foundation of the estate plan. Now let's look at irrevocable trusts. So um, irrevocable trusts provide advanced tax and legacy planning opportunities. Okay. So a irrevocable trust is generally held outside of taxable estate and cannot be easily changed once established. So as the grantor, once you transfer assets, they are out of your state, you lose control over those assets. Okay. That's the nature of the irrevocable. Okay. So um, the primary advantage is to remove these assets from your estate in a high tax situation. So if you are over that threshold from a federal level, or you are in a state like Washington, where you have state taxes over a specific threshold, and that's actually something I want to mention too. It's a threshold. A lot of people, like I live in Massachusetts, so we have a $1 million threshold. So if my estate at death is $999,000, I don't pay estate taxes. If it's $1,001,000, I pay estate taxes on $1,001,000. It's a threshold that once you cross, you pay taxes on the total, not just the amount over the exemption. Okay, so that's something that you want to look at, and I believe Washington is the same way. They have the same threshold limits where you pay from $1 to anything over $1 million. Okay, so the that's just the beauty of an irrevocable trust, getting things out of your estate non-taxable. Okay, again, you do relinquish control, but the primary reason for that is for estate tax reduction. Now, assets transferred. Uh, so assets transferred today are going to remove future appreciation from the estate. Again, reduce estate tax exposure, and it's going to transfer wealth more efficiently across generations. And you'll see on your screen where we have the dynasty trust there. That's going to be one of the local trusts that we'll use to create multi-generational wealth and a true legacy. Okay. One of the most common irrevocable trusts are called ILITs. So that's an irrevocable life insurance trust. And I'm going to explain that a little bit. So you have a life insurance policy. Typically, these are done on survivorship policies, so a second to die policy. What that does is that reduces the cost of your policies because it's based on two lives as opposed to one. So in that situation, you're going to uh, purchase a survivorship policy for you and your spouse. The owner of that policy is going to be an irrevocable life insurance trust. Okay. Um, I don't want to get into how we're going to fund that because that's going to go into gift taxing and family letters. That's a much more complex exercise. And if anybody wants to talk about that, I'd love to talk about it. So set up a call and we'll go through it. Okay. So one of the benefits of that is that the life insurance is owned by the trust. Okay. So when it executes, a tax-free death benefit funds this trust. So the a trust essentially has zero assets in it until execution, and then that fund, that trust is funded with tax-free assets that can be used to pay off any tax consequences you have in your personal estate. So an example of that is I have a bunch of property. I have real estate. I've got 50 million in real estate, or 50 million real estate, farmland, just high value assets that you do not want to have to liquidate to cover estate costs. Okay, uh, the funds will be available to you. All right. Also used for other means of legacy planning. So I leave a vacation home to my kids, and I have 5 kids. Okay, it can be used to create a set of funds for upkeep for a property like that. So, kind of a cool trust. You can do a lot of things with it. And it's one of the best ways to do estate equalization and pay off any outstanding estate taxes you have. Another trust we're going to look at, I think I have, check this. So I have Spencer Trust, Special Needs Trusts. Again, there are about 50 trusts. I don't want to get into every single one. Okay. Um, Another one of the trusts that we want to look at for the irrevocable side are called GRATs. So grantor retained annuity trusts. These trusts are typically used for assets that have high appreciation value. So if you have low cost basis stock that you think is going to appreciate substantially over time, a lot of times these are good trusts for that. Now, these trusts can also provide income back to the grantor for a period of time while transferring all future appreciation to beneficiaries. So that's going to reduce your overall estate tax exposure. Uh, Another thing we're going to look at is it's called a SLAT. So it's a spousal lifetime access trust. So this allows a family to reduce estate exposure while still maintaining some indirect assets through a spouse. So a husband and a wife, the husband's the grantor to that. The wife still can receive some income from that and still have some access to the assets. Although it's irrevocable, structured properly, there is some workarounds where you can still have access to it, and it can still provide any needs-based funding that you require. Okay, and then finally, the dynasty trust, as I mentioned earlier, this is designed for long-term, multi-generational wealth transfer and estate tax planning. The legacy trusts, dynasty trusts, typically they're going to be for multi-generational wealth. Like the Kennedys probably have a few dynasty trusts because we are many generations in, and they are still all doing very, very well. So in situations like that, you would want to look at a dynasty trust.
I'll just get a couple more questions in
Yeah, go
right
ahead.
quick, if that's okay, Brian. Yeah,
Yes, please.
so we got how does estate protection work for those staying overseas?
Okay. So I knew I was going to get this question. So my expertise now at Alfonso, we have, so we're a tech-driven company. So the majority of our clients are engineers and developers. Right? So uh, that being said, we have a lot of clients that are on work visas and H-1B visas. So we have a whole department that manages the overseas tax issues. and oversees taxes on trusts. One thing I can tell you is in relation to life insurance. Typically, life insurance is tax free for U.S. citizens. If you're not a citizen, you could look at upwards of 40% taxes on any distributions or any uh, death benefit proceeds. So again, that's another reason that, especially if you are on work visas, looking at specific trusts to get that out of your name and try and avoid some of that. So that is one thing I know. So sorry if that doesn't really answer your question. That's just not really my area of expertise. But I do have someone on my team that specifically focuses in that, and I'd be happy to set up a call and you can get really a deep dive into the particulars on that.
Sweet. And the next one is,
Anything else?
could you cover GRAT? And when is that recommended and what are the nuances of setup?
Okay, so that's a good question. So grats again are going to be more relevant to high income and high net worth. So the more the ultra high net worth um, group, okay. And there's reasons for that because you can have you could have a brokerage account or an RSU. You could have those in a revocable trust, okay. And upon death, your heirs get to step up in basis. Okay, so you can avoid. So if it's in our if they're RSUs, okay, and you have RSUs that have substantial capital gains, okay, they don't have to concern themselves with those capital gains because they automatically get the step up in basis. Also, if you have, you were at a startup, so you've got, low cost basis shares in a company that's IPO'd. Okay. If you don't liquidate those and you pass those to your heirs through a trust, they get that step up in basis. So they don't really have to concern themselves with that. Now, where you would want to look at it is if, say, you're a Google employee and you have, Google stock at $100 a share, okay, and you have no intention of selling that, you just want to pass that down, um, but at a certain point, you may want to receive income from that. Okay, that's where you're going to want to use a grant because a grant is going to allow you to take the assets outside of your estate and still receive a little bit of income if needed. Um, Now, when you want to start thinking about that, I would say after you've already established your fundamentals. So you set up your revocable trust, you've done your will, you have an attorney that you work with that you're comfortable with from an estate tax standpoint, um, and you want to start looking at more uh, more intensive tax reduction. So, say you live in Washington, and you will be looking at up to a 14% estate tax. Okay, that's a good way to avoid that while still being able to provide a little bit of income. So that can be any some of their mid 40s. Um, I mean, ideally, you want to do it when your basis is low to capture all that appreciation. So it's kind of depending on looking at it from when you receive the shares, what their basis is, and what the expected appreciation is. So mid 40s, maybe early 50s.
Okay. And then the next one is, do you guys connect with estate attorneys and do you help manage the trust?
We do. Yes. So we have estate plannings that we work with specifically that work um, on these exact strategies. Okay. From anything from just doing, your basic 4-step foundation with the a living trust to more complicated tax planning and irrevocable trusts. So yes, we do.
Awesome.
Uh,
And what does the software provide to set up trusts?
okay. Actually, that's an interesting question. Um, so back in the day, they used to have these things called hit plans. Hit plans were basic. boilerplate estate plans. Okay, so when I say boilerplate, they're boilerplate trust, boilerplate will, okay, healthcare proxies and whatnot. Now, the issue with kit plans, and I would never recommend someone use them, is they have no legal oversight. They're not done by attorneys. Okay, typically a CPA might have one or might offer one. Different insurance brokers might offer them, but they don't have any legal framework. Now, in the past couple of years, 2 years, I guess, really, since AI started to really uh, help manage this space, a number of law firms have developed what's called software-based trust plans. Okay, so from a cost standpoint, they're uh, a lot less, a lot more inexpensive than actually having an attorney and sitting down, because unless you need, a really complex estate plan, if you want to set up a basic trust and a basic will, pretty straightforward. And law firms are now offering those, so you do have legal backing and guidance for them. And I think that going forward for your basic planning, that's what you're going to want to look at. So from a software perspective, so we're going to handle the advisory side. So we're going to handle the assets. We're going to handle retitling. We're going to handle Roth planning, different types of tax advantage savings accounts, um, different types of private equity that provide tax advantages. On the legal side, from a software standpoint, that's where we're going to look to the attorneys. And as I mentioned, software-based trust plans are now a lot more prevalent, and are at this point require serious consideration, just in my opinion. Okay. Anything else?
Uh, yeah. Can we share some literature to learn more about what's the best strategy for personal cases, or is that's going to be on the website, correct?
Yeah. Well. So it's hard to. That's going to be case by case dependent.
Mm-hmm.
Right? Now, I'm not going to send you information on an irrevocable life insurance trust if that has no value to you. But if you want to, there's on basic trust setup, certainly. Typically, how that works is when we do an evaluation and we look at everything and we look at where the liabilities are, and how we build the trust to maybe offset some of those liabilities, then in those situations we have specific literature based around on what our planning is. Okay? Whether that's um, Roth conversions, mega backdoor Roth conversions, whether what else? Um, that could be uh, specific types of trusts if the need arises. But really, it's going to be on
Mm-hmm.
a case by case basis.
Got it.
This will all be on a so where this is going to be recorded, so you'll have all these slides that you can look at.
Mm-hmm.
But really, the devil is going to be in the details, right? So when we look at the overall strategy, what is going to be applicable to the individual?